when this next crisis happens, it's going to be one of the worst that has ever happened because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now. It isn't, so this is, wow, 743.
Gold and silver remain two of the most misunderstood and undervalued assets in today's financial landscape. Despite record debt levels, ongoing currency debasement, and growing geopolitical instability, public sentiment toward precious metals remains muted. Instead, retail investors continue to chase inflated stock market valuations, ignoring the quiet signals that the next major crisis could be one of the worst in modern history. The Buffett Indicator is flashing extreme overvaluation in equities, yet coin shops are quiet, financial media rarely mentions gold, and mainstream portfolios remain underweight in hard assets. MikeMaloney, best-selling author of Guide to Investing in Gold and Silver and founder of goldsilver.com, spent decades analyzing monetary history, inflation cycles, and asset valuations. He points out that the official Consumer Price Index, CPI, significantly understates actual inflation because its calculation has been altered repeatedly over the decades. The shadow stats version of CPI, based on pre-1982 methodology, paints a far more alarming picture. If gold were to enter a bubble similar to its 1980 peak, when it dominated news headlines and was recommended by mainstream financial planners, the price could soar to extraordinary levels. Currently, gold's valuation relative to money supply M2 suggests it is still far from such a bubble. When measured against historical inflation-adjusted channels, gold is today closer to being undervalued than overpriced. Under the shadow stats model, the potential peak could imply $12,000 per ounce, while a midpoint between official and alternate inflation numbers still points to massive upside potential. The absence of mainstream excitement, combined with suppressed public demand, indicates that the bull market in precious metals is still in its early innings, and the smart money knows it. Now, we present the clips from MikeMaloney's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
According to the government CPI numbers, the price of gold is kind of near the top of its range. Like we're almost at a peak and maybe it's going to go down from here.
Right. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett Indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid-'80s, all of his models stopped working, and he was wondering why, and he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and what he uses for this alternate CPI is the government numbers from World War II to 1982. The method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically anytime the CPI is coming in too hot and it makes the administration look bad. It seems to get adjusted. So What have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are two sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone, and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in an airport. Oh my God, it's just unbelievable. Gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble, and so it shows that it should be, if the green government CPI was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the last, all the financial planners switched to recommending gold. Put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that. A lot back in 1982 when this movie came out. And John Candy Brewster has to spend $1 million in like a month or something like that, which was almost impossible back then. And just on living, just stupid stuff. And John Candy's trying to protect him because everybody thinks he's gone nuts. So John Candy gets this financial planner. Now, this is 1982, after gold's peak. He's going, oh, yeah, this guy has me in collectibles, and he's got me in this and that and precious metals. And so they're showing, it just shows how everybody chases yesterday's news. We are nowhere near a top, or you would be seeing lines in front of coin shops. You would be seeing dealers running out of metals. This is nowhere, it doesn't make any sense at all that it would be up near the top of that green valuation channel and be in the same type of bubble that it was in back in 1980, measured against the rest of the economy.
If we do follow the shadow stats valuation channel, that would imply that, first of all, gold is basically the cheapest it possibly could be, the cheapest it's been historically. Mm-hmm. And that it should go up to roughly $34,000 an ounce the next time it hits a bubble.
Okay.
Yeah, and as you mentioned, Mike, the truth is probably somewhere in the middle. So the CPI understates inflation. The shadow stat CPI might overstate it. So what I have here is a very similar chart, but instead of this green line, I have a different green line, which is M2. And M2 is like right in the middle. And you can see that gold is pretty nicely sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CPI line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve, and they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent of what you it's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle.
Silver's position is even more compelling. Looking at long-term inflation-adjusted valuation channels, silver has spent years languishing below its historic range, in some cases breaking through the bottom entirely. Using the official CPI, a peak might suggest a price of $200 an ounce, but using the shadow stats methodology, the top of the channel could indicate potential prices in the four-figure range. While $1,000 silver may seem extreme, triple-digit prices, $100 and beyond, appear highly probable. The analysis also compares silver's performance against other major asset classes since 1980, including real estate, the stock market, U.S. Treasuries, GDP, and currency supply. On nearly every measure, silver has lagged dramatically, suggesting significant room for mean reversion. Even without a surge in monetary demand, returning to fair value levels could mean multiples of the current price. Historically, during periods of severe currency debasement, precious metals not only preserve wealth but also dramatically increase purchasing power relative to other assets. In the early 2000s, for example, gold and silver holders could purchase significantly more real estate, stocks, and goods than before, even as the dollar's value declined. The setup today mirrors past periods when silver was deeply undervalued and ignored by the masses. Eventually, investor psychology shifts, often rapidly, as gold prices rise to levels perceived as too expensive, prompting a surge of capital into silver. When that inflection point arrives, history suggests that price movements can be swift and dramatic. Let's get back to the interview.
I have the same charts here for silver. So starting off with the government CPI as well as the shadow stats CPI, you can see if we look at the green valuation channel that silver kind of broke through the bottom there for a solid decade, and it's sort of in the bottom half still. And next time silver hits a peak, according to the CPI, we might expect $200 an ounce silver. But
Right.
But if we take the shadow stats CPI, then we're still far below this valuation channel. We're below the bottom of it. Like, we've fallen out of the bottom. We got to get back into it. And then if we hit the top, that would be $2,000 an ounce silver.
So we've got, these are both government numbers, basically. And so we really should call them low CPI and high CPI, because they both skew on either side of that M2, which does measure every dollar has to go somewhere. So that's the measurement of how many dollars are floating around in the US economy, basically. And they're all seeking out goods and services. And so the M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now. It isn't. Okay. So this is, wow, 743.
I've got something from the book here. The question, where might silver go? So yeah, you've talked about this before, Mike, but basically what we did
we're
was
just adjusting it compared to all these other financial assets. And it's what percentage change did real estate, the stock market, the 10-year treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs, because we used the intraday high of 52.50 instead of $50. So, so this corroborates that M2 scenario of inflation. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100, 200. That still would not, compared to those other financial assets, that 200 wouldn't be in a bubble. The CPI the current one, the low CP lie, is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book, I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. So you take a $100,000 car and it goes to $1 million. And we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing, but you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been? I can buy so much more real estate, stocks, just about everything. I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. Okay. Silver is a percentage of global financial assets. And this chart ends in 2015. So it's old, but 2015. So the price of silver is more than double what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain. Mm-hmm. They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400. And people changed their preference in late 79 from gold to silver once gold was perceived as being a little bit on the expensive side.
The market's apathy towards silver today is striking, especially when compared to the mania of 1980. Back then, silver's share of global financial assets surged as prices spiked, driven by widespread public participation and a shift in investor preference away from gold. Today, silver remains a fraction of that historical proportion, even after doubling from its 2015 lows. This disconnect between current sentiment and long-term value potential offers a rare opportunity. When gold eventually reaches levels that the public perceives as too high, perhaps around $5,000 per ounce, silver could become the go-to alternative. This dynamic played out in late 1979, when gold's rapid ascent caused investors to pivot into silver, triggering explosive gains. The same psychological shift could easily occur again, particularly given silver's much smaller market size and greater volatility. The takeaway is clear: we are far from a true bubble in either gold or silver. There are no lines outside coin shops, no shortages dominating headlines, and no broad recommendations from mainstream advisors to allocate heavily to metals. Instead, we see quiet accumulation by informed investors who understand that monetary history favors those who position early. As global debt climbs, currencies weaken, and inflation persists, whether acknowledged officially or not, precious metals remain one of the few assets capable of protecting and multiplying real wealth. Those who wait for the headlines will be too late. Those who act now could find themselves on the right side of history when the next wave hits. If you found this analysis valuable, please like this video, subscribe to the channel for more in-depth market coverage, and share your thoughts in the comments below.